everyone, and thank you for watching my videos. We are now going to study the relationship between two currency pairs. By doing this, we can achieve greater success when we are investing in the Forex market. So, let's talk about currency correlations and how this works. Correlation, it's a measure of how two securities move in relation to each other. So if you remember from my previous videos, we talked about studying the gold market, the oil market, studying various indices such as the Dow Jones, FTSE, DAS, and NASDAQ, and the Nikkei. Because what happens in those markets has an effect on what happens in the Forex market. However, this time we're talking about currency correlation. We're talking about one currency pair and another currency pair and examining how they are related to each other. So you see, many Forex investors use this information because, number one, it gives us more information that we need in order to make sound decisions as to whether or not we should go long or go short on a pair. And it's also a great way of using risk management. So, and remember, that's the key to succeeding in the Forex market, is to be successful and solid risk managers. Okay, so how do we calculate correlation? It works like this. Perfect positive correlation. It means the coefficient is a +1. It means two currency pairs move together 100% of the time. It means we have this currency pair. Let's say we have currency pair 1 and currency pair 2. If currency pair 1 is showing a strong bullish trend, currency pair 2 will show the same bullish trend. They will both range at the same time, and they will both be bearish at the same time. Now, a perfect negative correlation, it means if currency pair 1 has a strong bullish trend, that means currency pair 2 will have a strong bearish trend, vice versa. And if the correlation trend is 0, it means currency pairs A and B are not affiliated with each other at all. The movements are solely independent. So, when we look at the many different pairs in the Forex market, some currency pairs move in a direct proportion with each other. Some currency pairs move in an inverse proportion, and other currency pairs are not affiliated with each other at all. So, let's talk about reading a correlation table. Now, we have the euro-dollar pair on top. And if you look at this left column, we have some time frames. We have a 1-week frame, a 1-month frame, a 3-month frame, a 6-month frame, and a 1-year frame. So in each other column, we have other pairs. And these pairs will tell us how much of a relation they have with the euro-dollar pair. So let's compare the euro-dollar pair with the US dollar-Japanese yen pair. So if we look at the 1-month pair, it means there is some degree of symmetry within the two pairs. And because it's a +6, it means the movement appears to be in the same direction. However, let's move to the next column, the US dollar-Swiss franc pair. Now, there's a high correlation between the two, but it's an inverse proportion, meaning in a 1-week period, what's been happening is that the euro-dollar pair has been moving in one direction. The US dollar-Swiss franc pair moved in the opposite direction. So there's a perfect negative correlation. Now, as we expand the time frames, there has been some deviation from that -1, but close enough, which means what happens in the euro-dollar pair will have the opposite effect on the US dollar-Swiss franc pair, or more likely. So if you're the type of investor that wants to save money on spreads and transaction costs, or if you're looking to make money on carry trade, we want to compare the different interest rates on the different currencies and the distance between the bid and ask prices, we can save money when we open and close our transactions, and we can make more money on carry trade by choosing the currency pair in which the bid yields high interest. Okay, so and then let's look at some other currencies. Let's look at the euro yen pair, and there's almost a positive correlation within a 1 week period. However, within a 6-month period, that relationship seems to have been distant, and to almost there was no relation. And however, if we look at the Australian dollar US dollar pair, the correlation seems to be high within that 1 week period. Meaning, what happens in the euro dollar pair seems to have a similar effect to what happens in the Australian dollar US dollar pair. So again, we look at the two pairs, we compare the spreads, we compare the interest rates, and from there we can determine which currency pair would be a better decision for us in case we were trying to decide which one pair to invest. So again, here we can see where currency correlation is important in order to become a successful Forex investor. Okay, let's look at a different pair. Let's look at the US dollar Japanese yen pair. Now, as we can see, if we compare the US dollar Japanese yen pair with the US dollar Swiss franc pair, there seems to be some sort of symmetry within a 1 year period. Not so much symmetry within the 1 week period. So remember, relationships change from time to time. Sometimes the relationships can be a perfect positive. Sometimes the relationships can be a perfect negative. Whereas sometimes there will be no relationships at all. So there's a lot of volatility within the relationships between two pairs. So we have to watch out for that, because these numbers are not permanent. They change frequently. So that's one difficult part about using currency correlations, is the volatility between the two pairs, because the relationships change that frequently. Okay, so let's change the currency pair to US dollar Swiss franc. I'll give you a few seconds in order to determine which currency pairs are directly proportion and which currency pairs are in inverse proportion. Okay, and then as we can see, there is a perfect inverse correlation between the US dollar Swiss franc pair and the euro dollar pair. So that's a perfect inverse proportion. And also we almost have a perfect inverse with the euro yen pair. So all this information is very helpful when we're looking at different pairs. And also this helps us to become diverse investors, because diversifying in the Forex market also gives us a tremendous advantage as well. Here's what the pound dollar correlation looks like with the other pair, so I'll give you a few seconds to examine that. And here's what the US dollar Canadian dollar correlation looks like with other currencies. Now we have the Australian dollar US dollar correlation. And notice that there's a high correlation with the New Zealand dollar US dollar pair. So remember, as I mentioned in previous videos, that there seems to be a very close relation with the Australian economy and the New Zealand economy. Remember, what happens in the Australian economy has a big effect on what happens in the New Zealand economy. So that explains the high positive correlation. And now let's look at the New Zealand dollar, US dollar. And we can still see that correlation with the Australian dollar, US dollar. And now let's shift to the euro yen correlation. And now let's shift to the euro pound correlation. Now, here's what these numbers mean. So when we see a -1, that's a perfect inverse correlation. If we see and as we gravitate towards 0, that means there's no correlation, totally random. And a +1 is a perfect correlation. So again, numbers that are closer to a solid 1 means that there is a strong relationship between the two currencies. Numbers that are closer to 0 means that the relationships are not there. So what we're looking for is anything higher than 0.5, whether positive or negative. So really anything higher than 0.5, there is some sort of relationship present. So keep that in mind. Now, why is correlation important? It eliminates counterproductive trading, and it also gives us an opportunity to leverage profits, diversify risk, and also this gives us an opportunity to learn how to diversify the Forex market. And also, this is a great way of using technical analysis, going back to technical analysis now, in order to confirm whether or not we have a trend. So looking at a different chart can be an indicator itself. Now, about correlation changes. So remember, these numbers are never permanent. There's a lot of volatility in the correlation. So remember, a positive correlation can turn negative quickly, and then there will be no relation. So it changes frequently. So here's an example of how correlations can change. So let's look at the US dollar Swiss franc pair. So as we notice, there's a lot of positives, negatives, and ratings closer to 0 and ratings closer to 1. Same thing with the euro dollar pair, same thing with the New Zealand US dollar pair. So again, lots of ratings closer to 0, lots of ratings closer to 1 or -1. Now, I'm going to show you how you can calculate your own correlations, and you can do this on your computer. So, number 1, we have to get the currency data for the past 6 months. Okay? Number 2, open Microsoft Excel or any other spreadsheet software for those of you that have Apple. Well, actually, Apple does have Microsoft Excel. Most of them do. That uses the correlation formula. So number 3, copy and paste all of the data from step 1 to the empty spreadsheet. So again, we're looking at a pair and we're listing all of the closes for the past 6 months, and we're going to transfer that information to the spreadsheet. Okay, so I'm going to walk you through this here. So here we have our spreadsheet as we see. Here we have our dates we're going to plug in, and we're going to plug in all the closes from the euro dollar, all the closes from the US dollar Japanese yen, US dollar Swiss franc, and the pound dollar closings. So we placed in our dates. And we placed in all the closes from the euro dollar pair and the other 3 pairs as well. Okay, so I'll pause for a couple of seconds so all of this information sinks in. Okay, time's up. And then we're going to highlight these blocks right here. So as we know, if we look at the euro dollar closings and the dollar yen closings, we have some areas that are highlighted. Now, in the space below the euro dollar column, type this code. Now, there's a reason why we highlighted those blocks, and it's because we have to type in this information on the bottom. And then decide on the time frame you are looking for, and after the parentheses, add the range according to the boxes. So here we have to decide the time frame in which we want to get our data from. And by doing that, doing that, we put this information here. So what we're going to do is the area that we highlighted, actually let me go back to the, let me go back here. So as we can see, we have 5 areas highlighted, and we have 5 areas highlighted on both the euro yen, the euro dollar pair and the dollar yen pair. Okay, so I'm gonna go back and watch what I do here. So these codes right here, B2 to B6, C2 to C6, these represent the areas in which I've highlighted. And now look what happens. Look on the bottom down here. It gives us the correlation between the week, in the week of August the 3rd to August the 6th, between the euro dollar pair and the dollar yen pair. And we have an almost perfect negative correlation during the week of August the 3rd to August the 6th. Okay, and then we repeat that for all of the currencies and whatever time frame that you decide on. So what I just showed you was the correlation for the week. If you want to do the correlation for the month, you would just change the configurations according to the blocks that you highlighted. And we can just repeat that as many times as we want, and then we will have this information. Okay, so all of this information you type in yourself, of course, but we can always round up so everything fits in. So as we can see, the correlation of the euro dollar pair in relation to the US dollar Japanese yen pair, the US dollar Swiss franc pair, and the British pound US dollar pair. And then we have our list of closings, and we have our time periods, 1 week, 1 month, 3 months, 6 months, and we can see how these currency pairs have been moving in relation with each other during those time frames. So again, this gives us the information that we need in order to determine which currency pair is the right currency pair to get involved in, if we're trying to decide. Or maybe you want to get involved in both. It's up to you. Okay, so again, how to calculate your own correlations. Although there are no strict rules in monitoring the correlations, some people find it more beneficial to use the time periods of 1 week, 1 month, 3 months, and 6 months. So again, you can change it however you want. If you want to use 4 months, 5 months, 10 months, it's up to you. But many investors find it useful to use the periods of 1 week, 1 month, 3 months, 6 months. So, however, if you do plan to use this tool often in your trading plan, then make sure that you update this every week, because this is a volatile market, so many things change throughout the week. Okay, so here's what we've learned so far in this video. We've learned that coefficients are calculated by using daily closing prices, and positive coefficients indicate that they generally move in the same direction. Negative coefficients means they move in the inverse direction. Now, here's what I'm going to do. I'm also going to show you so many different currency pairs that historically or traditionally move in the similar direction or the opposite direction. But first, you do have to realize that correlation coefficient values near or at +1 or -1 means that the currency pairs are highly related, as we pointed out. And also, correlations can be used to hedge, diversify, and leverage up positions, and also helps you become better risk managers. So again, we're looking at 2 currency pairs, and we can determine where we can save money on the spreads, and also where we can make money when we use carry trade. Okay, So here are some examples of two currency pairs that traditionally move with each other. So we have the euro dollar pair and the pound dollar pair. Euro dollar pair and Australian dollar US dollar pair. Euro dollar pair and New Zealand dollar US dollar pair. Also the dollar franc pair and the US dollar Japanese yen pair. And then we have the Australian US dollar pair and the New Zealand dollar US dollar pair. So historically, these are the pairs that move in the same direction. And historically, these are the pairs that have a tendency to move in the opposite directions. Now, I do want to highlight, though, the euro dollar pair and the US dollar Swiss franc pair. So remember, we're talking about European currencies that have that cause a lot of volatility when they are traded against the US dollar. So it's very easy to see that what happens in the euro dollar pair, the same thing is happening in the US dollar Swiss franc pair. The only difference is that the US dollar is the quote currency against the euro, and the US dollar is the bid currency against the Swiss franc. So common sense should tell you that if we wanted to open positions in both currencies, don't go long on those two currencies. Go long on one currency and go short on the other, because we can maximize our profits that way, and also by studying the relationship between the two currency pairs, it would also help us to minimize our risk as well. So remember, stick to your trading system. Don't go higher than the percentage that you've set before when we want to manage our risks. For example, if you don't want to trade if you want to be a 1% trader, don't trade more than 1% of what's in your account. So remember, stay under that percent, and then we can last in the market long enough to take advantage of those great profits that are out there. Thank you for watching this video, and good trading.